coming. I'd like to introduce you to our guest, Professor, but before that I'd like to say a few words about the BRICS Network University, which is the program in which we are working together. You probably listed something about it, but just to say a few more words. It's an initiative that was organized by the Ministry of Education in the 5 countries, and the idea is organizing academic collaboration with universities from the 5 BRICS countries, obviously, in 6 axes, strategic axes, and then one of them is precisely economics. Then we have partners in all 4 countries. And in China, we have 2 partners. One of them is Beijing Normal University, where Paulo has done a summer school or something like that, a summer course. And the other one is Henan University, where Professor Makram comes from. So he's originally from Germany, but he has been teaching in China for the last 4 years in the field of monetary policy and monetary economics and so on. So we met in this meeting for BRICS Network University, and since Professor Makram, he was coming to Brazil for a conference in Rio de Janeiro, he was so kind to offer his time to come here to Campinas and to Belo Horizonte, where we also have our partner in the BRICS NU, pela, UFMG. Okay, so he arrived from China yesterday, and he came directly from, he slept in Rio, and then he came directly to Campinas to give this lecture. Henan University, maybe Makram can also say a few words, but it's located in Kaifeng, which I learned today is a former capital city in China. So it's in the middle of China, in Henan province. And he's also, besides being a professor, he's also the director of the Center for Financial Development and Stability there. That's it. And today he's going to talk about the monetary policy in China. All right. So Makram El-Shagi, I should have also named your family name. You have, well, 40 minutes, 1 hour, or it's up to you. And then we can go to the discussions. Okay.
Excellent.
Thank you so much.
So, thank you so much for the kind introduction, Bruno, and thank you so much for inviting me. So you described very well how I harassed you into inviting me here. I have to apologize. I will start with the apology of having the typo in exactly your name, which is very embarrassing. In my defense, I changed the name on those slides in the 2 hours which I was awake yesterday, which from my perspective was something like 3 o'clock in the morning. So that was the best I could do at that time. I hope I will do better today, because again, it's like 3 o'clock in the morning for 8 o'clock. So don't take anything I say too serious. This is joint research with another faculty member at Henan University, and actually the deputy director of the institute, Jiang Lunan. And it is about monetary policy in China. And I kind of want to stress the in China here, because what we try to do different from a lot of papers that are already out there is we actually try to account for first differences in how the People's Bank of China, the PBOC, conducts monetary policy, as opposed to, for example, the Fed or the ECB, and the institutional framework that exists in Chinese financial markets that really changes how monetary transmission works. Because what a lot of people just do, basically, when like Western scholars began to be interested in China, they pretty much took established Western models and just estimated them for China. And well, as long as it's a purely reduced form, that doesn't really matter much, but as soon as you have any structural interpretation, actually you can pretty much mess up things. Like if you have basically the wrong structural assumptions. And so this is kind of a, well, it's a VAR, but it's a structural VAR, so we do believe we have structural identification. And so we try to really account for what is special in China. And Bruno asked me to focus a little bit on that part. So what's usually the motivation, I will try to delve a little bit into that, I will try to delve a little bit more into that and tell you a little bit more about this institutional background that we feel has to be modeled in a bit more detail, and which is one of the things we attempt here. And So if you have questions, just ask. I will try my best to answer them. A lot of that stuff I say here about the institutional background I learned myself for that paper, so I'm not sure how much more than what I say I can tell you, but I will definitely give my best. So that already was the motivation. So let's go to the institutional background, which is like what we feel is really interesting. So as I said, there are actually two parts of the institutional background that we feel has to be considered. And the one which might be even the more important one, is the very different financial market. I mean, we don't have unregulated market in most of the West, but they're pretty much unregulated enough that if you look at major rates like interest rates, you can just treat them as a market outcome with maybe some persistence, but at the end of the day, that's it. You just, interest rates are interest rates, and that's all fine and good. However, China has a much more regulated market, and what's more important is it has a much more segmented market. In particular, we are talking here about the bond market. Why is the bond market so important? Because the bond market is where open market operations happen, like that's in China as it is in the US or it is in Europe. I have actually, to be honest, no idea about Brazil, but I assume it's the same. So it's pretty much the bond market where monetary policy happens. The central bank buys and sells bonds. So in China, there are actually two bond markets, not one. So there is the interbank market and the exchange market. What I have to say first about those is a little bit counterintuitive when you hear it first. The interbank market is the much larger market. The exchange market is the much more liquid market. At first that sounds very unusual. So how can that happen? Basically, the interbank market is the market where first monetary policy is conducted and where the big players trade. So you all have heard about the big five, well, usually the big four, but it's actually a fifth, considerably smaller one of those big state-owned Chinese banks. So those and a few other major private banks and insurance companies trade on the internet market, and so does the PBOC. So basically what happens there is that you have very big players who occasionally make very big trades. So what's happening there is purely, and that's why here trading rules are one of the big differences, it's basically purely over-the-counter business, and it's usually large. So actually the prices are kind of idiosyncratic. There are huge shocks to those prices because it really depends on what's happening on this specific day. If the specific bank, for really some strange reason, has to get rid of a giant package of some kind of bond to rebalance their portfolio. And so actually, if you look at the data for yields, you will see much more volatility over the yield curve. So at any given point in time, not just over time, but at any given point in time, you have much more volatility in the yield curve over maturities on the interbank market than you have on the exchange market. Because again, it's like a few major deals which have a lot of factors that we can't really observe and that are probably not really part of the actual trade that we see. Then we have the exchange market. And the exchange market is really what we think about as a normal market. There's a lot of participants, pretty much everybody can trade. Well, not everybody, but like in the realm of normal regulation, most companies can issue bond there. Most banks, or pretty much every smaller bank, can trade there. They can buy bonds, can sell bonds. So there are a couple over-the-counter transactions on this market, but as a rule of thumb, this is a proper exchange. So basically, you say, I want to sell this, and I don't want to sell it for less than this minimum price per bond, or you say, I want to buy, and I don't want to pay more than this maximum price per bond, and then there's a market maker that basically matches and gives you a price and tries to sell it. So that's a proper exchange. And because it's a proper exchange, it has proper arbitrage, there are proper prices, and you have a reasonably smooth yield curve. Not as smooth actually as you have in the US or Europe, but much, much smoother than the exchange, than the interbank market. So we have the big one, over the counter, we have the small one, smaller one, which is a proper exchange. And technically, they're completely separate in both who trades and what is traded. So if you issue a bond on one of those markets, not on both. And most companies can only issue bonds on the exchange market. But for example, the one big exception is actually government bonds. So government bonds are traded in both markets. Not one and the same bond though. So basically, one bond, when it exists as one bond, like imagine a bond still was like 100 years ago a physical piece of paper, one piece of paper would stay in one market. But the government issues bonds in both markets, and so they are traded in both markets. So we have papers, bonds, that for any practical purpose are more or less perfect substitutes. So we have a 10-year Chinese treasury bond interbank market and a 10-year Chinese treasury bond exchange market. They have the same risk, the same everything, but they're not the same. They're traded on different markets and can have different prices. And there is no immediate arbitrage. Why? Because as I said, it's not only what's traded that's more or less completely separated, it's also who trades. That is, the major banks who trade on the interbank market are not just allowed to go to the exchange market. So they cannot say, oh, I buy here on the interbank market, then I sell on the exchange market. Then very obviously you would have immediate arbitrage. But there is nobody who can do that, because when you trade on the one market, you're not allowed to trade on the other market, with very, very few exceptions and a very, very strict regulation what they can do. So basically, we have perfect substitutes on two different markets which are completely separated institutionally. And that is what makes China so different, because basically for any practical consideration, you would say the exchange market is the more proper market rate. That's what's happening in the economy. However, monetary policy is not conducted there. Monetary policy is conducted more or less exclusively on the interbank market where the big transactions happen. And that is why transmission is so different from the rest of the world. Because basically monetary policy is conducted on a mostly irrelevant market. Also here, illicit is a difference, and that's actually kind of interesting from the historical perspective. So I'm changing the order here a bit, is they're regulated differently, and that's actually how it all came to pass. So the interbank market is regulated by the PBOC. The exchange market is regulated by the SEC, which is pretty much the normal stock exchange supervision. And actually that's how it all happened. So initially, actually the older market, again it's the now smaller market, so the original one existing market was the exchange market. So then in the, I think, early 90s, there were a couple of heavy speculative attacks against the Chinese RMB. And the PBOC was not really happy how that was handled by the big banks and how they responded. So they wanted to have tighter oversight. And that was the original reason to kind of remove those big players, kind of the too big to fail people, into a different supervision and have them trade on a separate market where the PBOC can monitor them more closely. So that's why they have this different setup. So it's now seems very weird, but the original thinking was basically to have this as macroprudential policy. And well, in a way, so far it worked. So far China had no major currency crisis, but they're now also stuck with this kind of very weird financial system. So what's another difference? When you think, or at least maybe I'm just the only idiot, but when I thought about government debt and, government bonds, I thought, well, there's an obvious reason why they are issued, that is because the government needs money. But actually that's not the only reason why some Western governments issue bonds. Bonds of the major fully developed countries are usually considered risk-free. And it's actually, for your financial markets, a very good thing to have risk-free assets of different maturities. But in China, for a very long time, you didn't have that. like the Chinese treasury bond for the Chinese market can be considered risk-free. I mean, unless the whole thing collapses and then kind of everybody there goes down anyways. Like basically, if you're a Chinese citizen, Chinese treasury bonds are the next best thing to risk-free that you can get. However, initially they issued bonds when they needed money. So you had a couple bonds, and then you did not have a bond for a year or two, then you had a big spike of bonds. So basically you didn't even have a yield curve. You just had like individual spots for those bonds that were issued because they needed money. And it's only a very recent development that the Chinese treasury, together with the PBOC, kind of decided it would be nice to have something like a yield curve. Especially, that has actually also to do with the financial crisis, when controlling the entire yield curve became more of an issue for most central banks, not only the Chinese one. But to control a yield curve, you actually need to have a yield curve. Like you need to have interest rates over different maturities that you can say, okay, they go up, they go down, something happens. And so actually in 2008 is when the Chinese treasury really started issuing more and more bonds at different maturities. Not so much because they needed more money, but to really deliberately fill the yield curve. So what's different here from the rest of the world, at least again, I never know really how to compare to Brazil, to be honest. So my comparison is always, when I say rest of the world, that's pretty much the US and Europe, to be honest. I have to apologize for that. So, but at least in like kind of the old industrialized world, you just had like a full yield curve for decades now. In China, that's a very new thing that really happened deliberately. So it was not just developing, they really wanted to have yields at different maturities, and now we have issued regularly bonds of 1, 3, 5, 7, 10, and very, very occasionally 50-year maturity. So now, in China, for about 10 years, there are proper yield curves. And again, that is kind of a very new thing in China, and that's why our data set here is very short, because for us it's really all about how the yield curves on those markets interact in response to monetary policy. So third big difference is how the PBOC works. When you say first, like, okay, it has many different tools in its toolbox, it sounds a bit weird because, of course, every central bank has that. Like, they have open market operations, they have whatnot. But at the end of the day, if you look at most central banks, and actually I'm fairly sure that it's not only the ECB and the Fed in this case, it pretty much all boils down to this one intermediate objective, which is, for example, the interest rate as it is in the US, so there the intermediate target is the federal funds rate, or in some more traditional approaches, it is the quantity of money, but there pretty much are a lot of like kind of tools, but they still all go to one intermediate objective or intermediate target that then is supposed to affect the final outcome. So in the US, and actually by now Europe, we want to affect interest rates, and through affecting interest rates, we affect inflation expectations and inflation. That changed a little bit, of course, with the great financial crisis because we hit the zero lower bound. Then again, we looked at quantities, but that kind of, even that actually like sparked this huge literature on shadow rates, which kind of shows you how important from like a European and US perspective this idea is that there should be one measure of monetary policy. And in China, we feel the tools are really used for different objectives, partly overlapping, but still different enough that different policies should really be addressed differently. And actually that's a big question now in this like line of research, so among those people who kind of try to look at China as really a different thing, that's a big debate now. So there kind of is a consensus that there is no one good measure of policy, that you cannot just look at one interest rate like the Fed funds rate in the US. But there still is this debate whether you could theoretically combine all those measures, even though there is not one unified market that gives you one good outcome measure. But the question still is, could you still theoretically combine them into one aggregate measure of the policy stance? Or are they really different components to policy? So here we go the approach that we say, no, they're different tools with really different objectives. They should not be mingled because they are really different. But actually, a colleague of mine is kind of working on the question whether you can combine them after all, and if there is something like a unique policy index. But again, everybody agrees you cannot just look at one interest rate. Well, everybody who really wants to treat China differently agrees you cannot just look at one interest rate and say that's the policy stance. So there are a bunch of measures. 3 kind of are probably the important one. We can only look at 2 of those here. So what are those? So first, like the PBOC still works a lot with reserve ratios. And actually recently it has done so a little bit more. Like this year alone it had like 2 changes, 2 or 3 actually, of the required reserve ratio. But over our whole sample they're just not enough, especially since this paper uses data until the end of last year. So there were not enough changes to really identify that. So we have to ignore the reserve ratio just because there's not enough variation in the data, but we would say it is something that should be considered separately. Then you have open market operations, and they pretty much target the repo rate as kind of the interbank, or repo bank and interbank rates, which are very close to each other, as kind of the intermediate interest rate target. So that's the next best thing. So if you look at China, the repo rate, if you want to have something like a Fed funds rate, the next best equivalent would be the repo rate. There are, of course, a couple of liquidity, like special liquidity measures and like kind of macroprudential policies, but those are usually like idiosyncratic one-time events. But then another thing that's actually happening a lot are changes of the so-called benchmark loan and deposit rate. And that's actually what makes it really interesting, because here we have 2 interest rates, and those can be really different, and monetary policy affecting those is really different. So again, repo rate is kind of the outcome on the market of what happens based on open market operations to, well, interest rates paid by banks. But then the PBOC also goes and says, you know, I think loans should, on average, be at 3%. Technically, that is a target. So something like the Fed funds rate. Practically, it's regulation. Why? Because you have those 5 really big banks that are government-owned. And basically, part of their common career path is the PBOC system. So it would be a very common thing that you're a manager somewhere at ICBC or a Bank of China, and then you switch and become governor of the Henan branch of the PBOC. And so generally, since you're part of this big government system, you don't want to mess with the PBOC. So even though it's technically something that they say, oh, we think it would be good, and are supposed to do policy, they don't have to. If they say, we think 3% is a good loan rate, the average loan rate of the major banks in China will be 3%, full stop. Just to clarify, that does not mean that every loan is 3%. Like the spread is huge. Like in many cities, it's now almost impossible to get housing loans because they have often now fairly high interest rates. But on average, the major banks will make sure that they come very close to this PBOC objective. That is, for any practical purpose, that is regulation. You see, we mentioned 2 here, loan rate and deposit rate. Why is only one blue? Because the blue ones, repo rate and benchmark loan rate, are the ones we actually consider in the VAR model. And benchmark loan and benchmark deposit rate, in 99.9% of the cases, just move together. So the spread was utilized very, very little. So usually they say, we think deposits should pay 1% more and people should 1% more for loans. So that's why there's really like, if you basically, in a sample as short as ours, if you include them both, you just have no identification anymore, because I think in our total sample we have 2 cases when they don't move together. Well, they never move in opposite direction, but we have 2 cases where they don't move by the same order of the same magnitude, so there's really not enough variance. If you had a 30-year sample, you might treat that differently, but in our sample, it's literally impossible. Here. So here I want to give you some more evidence that I'm not just fantasizing, but that those loan rate changes are really not backed up by policy. So this is basically an event type study. So that's not really our model. We will do a proper model later, but that's just an event type study thing. So here, this black line is when a benchmark loan rate change happens. And that's weeks before, weeks after. And what you see here is cumulated open market operations. So we know how much million, billion RMB the PBOC bought or sold, so we can just add them up. And the gray area here, what you see is a 90% confidence bounds when nothing happens. So if there is no change in the benchmark deposit rate. So over like 15 weeks, starting here, that is how much open market operations over 15 weeks usually add up to. Like between 5 billion plus and well, actually more, 10 billion plus and minus, adding 10 billion to the market, removing 10 billion to the market. That's usually what happens over the course of 15 years. And all the lines are actually what happened around a specific policy event, like increasing or decreasing the benchmark loan rate. And what you see here is that every single of those lines is within the 90% confidence bounds, many of them actually fairly close to the middle. So pretty much the distribution that you get from the endpoints of those lines could very easily be drawn from that total distribution. So in other words, there is no evidence at all that the PBOC backs up their benchmark loan rate changes with open market operations. And again, that's why we say it's basically a different thing, it's regulation. Because when you look at other countries, what happens is if you change a target rate, the whole point is that you then actually achieve that target by providing the liquidity. The rates might adjust a little bit faster because of expectations, and basically in the US, when the central bank changes the Fed funds target rate, the Fed funds rate changes immediately because the banks know that they are going to be provided with more or less liquidity, but still that liquidity provision eventually happens through open market operations. And here it doesn't. So if they say we should increase or decrease the loan rate, open market operations wise, everything is like as always, nothing changes. And that is kind of the big difference here. So that's why we say we really have to consider at least those two policies, loan rates and Fed funds rates. So that's really all I can say about law. That's all that I want to say about the institutional background. If you have more questions about that, that's a good point to ask. So otherwise, anytime you can interrupt me. Any questions on that, or I will just... Okay, then I will just continue.
I have a question about the concentration. Do you know how much these five big banks control the market? By how much?
I think it's around 80%, but don't quote me on that. But it is a lot. It is decreasing though. So I'm not sure how old that data is, if that's actually new or the old one. But they are pretty much like the huge share traditionally of banking is done by those five banks. And then of course, like a lot of the smaller banks are also government owned, but not by the central government, but by municipal or provincial governments. So there is a huge share of still government-owned banking in China.
In terms of concentration, Brazil is the same. We have 5 big banks that have something like 90% of the market share. But the difference is precisely that among these 5 banks, only 2 are public, and then 3 are private. So
yeah, in China, every really big Chinese bank is still government-owned. And it's actually the 5th one is not that big. It's pretty much Bank of China, which I think is the largest, ICBC, so Industrial and Commercial Bank of China, Chinese Agricultural, and the Construction Bank, Chinese Construction Bank. So CCB. Those are kind of the big 4 that kind of really make the market.
Just one question. Exactly, sorry if I lost it, but what exactly is this benchmark loan? Is from who to who? From the Bank of China to the banks?
No, that's the loan rate paid by you and me if you want to get a loan. So it's really like the loan rate, like the.
Okay.
Well, I think it's technically the 1 year loan rate. So for short-term loans. I think, but again, like I have to double check. But I think the one we use here is the benchmark loan rate on short-term loans.
So they focus on both, on the repo rate and the benchmark loan.
Yeah, but again, like the repo rate is kind of what they observe as their intermediate target.
Yeah.
So they don't make official policy announcement like there is no repo target rate.
Okay.
But the repo, so that's why I said the repo rate is not the best equivalent to the federal funds target rate. The repo rate is the best equivalent to the federal funds rate. So it's kind of the interest rate they actually control, but they don't really, at this point, have an official target for that. And that might actually change because they're moving more towards interest rate controls or interest rate based policies, so they might have that in the future. But at this point, no, they do open market operations. But kind of the thing that they're known and officially admit to kind of monitor and look at and concentrate on when they talk about interest rates is the repo rate. And then, again, there are loans and deposits. Again, just private consumers and banks. And there they have those benchmark rates, which officially are targets. So they think, we think that would be good, and we should do policy to achieve that. But de facto, they don't have to do policy to achieve that because everybody's just obedient. And so they don't do policy to achieve that. They just say, we think that is good. And then ICBC also thinks that is good. Completely coincidentally, at the same time, they have literally the same thought. That is a good interest rate. We should have that. And so they changed it.
And just out of curiosity, do you know the spread? How much is the spread from a normal loan to the repo rate or the benchmark rate?
Currently, not much, I think. But that actually has varied a lot. I mean, the repo rate is a money market rate, so it was always fairly low. Currently, the benchmark loan rates are fairly low towards the end of our sample, so I think it's only like a 3% spread or something. But it has historically been much more when loan rates were higher. Because basically the loan rates are more volatile than they're less, kind of hard to say. Like in the short run, they are of course like less volatile because it's kind of a step function, but the spread from maximum to minimum in the loan rates is more than in the repo rate, I think, if I remember the data correctly. Sadly, I think I don't have a data picture here. I should add that to the presentation, but I don't have one. I have to double check, yeah, but currently it's not very high. Okay, so the method we use here is actually like a two-step thing. So first we estimate yield curves, then we put the yield curves into our monthly VAR. Why do we do that? Mostly because we have very little data and we want to utilize weekly data to estimate our yield curves. Because that basically gives you more information, because even though they're now working on having a more complete yield curve, well, working on is not the same thing as having one, so there's still a lot of volatility within, like any single day within the yield curve. So not over time volatility, but the yield curve, if you actually plot from data point to data point, can still kind of be zigzagging around. So we really want to utilize as much information as possible to estimate our yield curves. And that's why we do it in two steps. We first estimate yield curves, because then we can use weekly data, and then we take this yield curve data and plug it into our monthly VAR with macro variables, which are not available at a weekly basis. We pick monthly, which already is kind of a problem because we don't have GDP monthly, so we have to use an industrial production index. But again, with a 10-year time frame, it's kind of problematic to use to use quarterly data. So what we use is actually a Diebold-Lee model, which is a variation on the Nelson-Siegel model. So just for those of you who are not into finance, the Nelson-Siegel model pretty much describes the yield curve as outcome of three factors, level, slope, and curvature through those three functions. I actually think I have a picture of those three functions. So basically, you have a weighted sum of those three functions that gives you the yield curve. So this is the level, the slope, and the curvature. And then you can see how they develop over time. In the initial approaches, you just basically did it slice by slice. So you estimated that just for any given day, you could estimate a Nelson-Siegel model, and then you have for this day level, slope, and curvature. What Diebold and Lee, I think, came up with is to treat those level, slope, curvature descriptors of the yield curves as states in a state space model. So they say, okay, it's weird if they just like move randomly around, so let's give them some persistence. So basically, you describe level, slope, and curvature in this kind of, if you wish, a VAR model of unobserved variables. So that's the state part of a state space model in the state space representation. And then basically every day that you include in your data, that kind of should describe your actual yield curve as good as possible. But in this way, you can basically utilize to stabilize your yield curve or stabilize your estimation, both cross-sectional data, like over different maturities, and data over time. And again, in China, that's kind of important because we have some days with very, very few observations. So we would have huge uncertainty if we would just estimate a yield curve for that day. And so here, we don't have that problem anymore. I'm skipping most of the technical part. So I'm focusing on the difference. So the difference between us and Diebold-Lee is that we actually have two markets. So we actually don't have three states, level, slope, and curvature. We have two levels, two slopes, and two curvatures because we have two markets, the interbank and the exchange market. And level, slope, and curvature on the interbank market should describe the yield curve on the interbank market. Level, slope, and curvature on the exchange market through this H should explain the yield curve on the exchange market. Note that here, this is block diagonal. So each one is a separate yield curve. So this is the interbank yield curve, this is the exchange yield curve. But if you look at the dynamics, that's where we allow them to interact. So actually, level, slope, and curvature on the interbank market today are allowed to affect level, slope, and curvature on the interbank market on the exchange market next week, and vice versa. And actually, we do basically a Granger causality test, which essentially boils down to a joint significance test of those blocks here, A12 and A21, and we do find both of them to be significant. So actually, we do find that both markets mutually Granger cause each other. There's no strict causality from one market to the other, but it actually goes in both directions, and they're also not completely separate. And that actually makes a lot of sense. Because if you think about it, think about a perfect world where there was perfect arbitrage. Initially, our thought was, oh yeah, then those should be really important, but that's actually not correct. Because if you had perfect arbitrage, they would immediately move together. So if you had perfect arbitrage, there should actually be correlation here in the shocks. And there is some, but not much, to be honest. So we do estimate that, we do allow, we have a non-diagonal covariance matrix for the state part of the states, for the unobservable part, so the state part of our model. So between the etas for the interbank market and the etas for the exchange market, there is allowed to be correlation, which exists, but it's small. In a perfect world, this would be super high. They would be correlated 1-to-1 actually, and those would be 0 because it wouldn't matter anymore. Anyways, we do not find that. We find low correlation here, and we find those to be really important, which basically means on impact, they're not really the same, but eventually they converge to equal. Technically, it just means they converge somewhere together, but they actually also converge together, and we can show that. So those are kind of the equilibrium yield curves for the two markets. Because we have this VAR process, pretty much for the states, we can just compute an equilibrium for that VAR, because in both cases we find it to be stationary. So the yield curve in China is stationary over our sample, and then you get those two yield curves, which are pretty much the same, except here. But this difference actually is insignificant, because at those very, very short maturities of like 1-2 weeks, we have very little data. So actually the confidence bounds here, if we had them, well, if we would have chosen to add them in the figure, would be huge. So that's not a significant difference, and after that they're pretty much indistinguishably close. So our data goes from 2008 to, actually I think we extended to 2017 now, but I'm not sure if I already updated the results. We focus on Wednesday observations. Why Wednesday? Because the PBOC always does its policy on a Friday. So by taking Wednesday data, we are sure that we give it enough time that an eventual monetary policy shock would have fully manifested. And it's early enough that there is no expectations effect on what will happen the next day or later that day. So definitely Wednesday, there's no monetary policy. It's sufficient time before and after. That's why we take Wednesday data for our benchmark. Weekly averages are kind of similar, but Wednesday data actually gives us the best results. We use maturities from 0 to 10 years with 3-month steps. We stop at 10 years because although there are some higher maturities now, there are not many. So actually, like, uncertainty if you go beyond the maturity of 10 years in China is still immense, because they have very, very few longer maturity bonds. So when I say they try to fill the yield curve, is they try to fill the yield curve up to a maturity of 10 years, and that's why we also have to cut at 10 years, because after that, it's kind of can go anywhere.
Just a clarification question. You said that the People's Bank of China started issuing bonds with different maturities and so on in 2008, I immediately thought it was due to the beginning of the international financial crisis. But since you have data from January on, it has nothing to do to Lehman Brothers or the financial crisis. Or it started in...
I mean, the financial crisis kind of started in 2007, but it's kind of hard to say. So it is the same time when they started discussing controlling the yield curve. Mm-hmm. So when they which probably was partly inspired by what was going on, but it's clearly it's not like when they hit the zero lower bound. So it's really like very early in the crisis when they already started doing that. Oh, and we still have missing observations. So we use a variation of a Kalman filter that is able to deal with missing observations. That's just a side remark. So then, as I said, we put that in a VAR. I'm usually not a big believer in Cholesky decompositions where you order, but here we are actually only interested in the monetary policy shocks. And actually there is this seminal paper by Cristiano, Eichenbaum, and Evans that kind of shows that if you think about like different blocks of variables, actually as long as you only change things within one block, but not the sequence of the blocks, actually the sorting within another block doesn't matter. So if you have block A, block B, and block C, you can change the sorting in block A and block C, and nothing happens to block B as long as you keep A first, then B, then C. So we actually don't need a specific Cholesky decomposition or a specific sorting. We just need some rough assumptions about a sorting, and kind of the standard way, which I also kind of agree is very believable, and I hope you agree with me, is that you kind of start with the real sector. So you say, okay, there's the real economy, the macroeconomy, everything can respond to the macroeconomy, but the macroeconomy does not respond to anything financial on impact. So prices, GDP, anything can affect the financial market and monetary policy immediately, but cannot be affected immediately. So that's why the macro block is first. Then we have our monetary policy block, and then we basically have the financial market sector. So the financial market in our case is liquidity measures, which is loans and M2. M2 because M2 for a very long time was kind of one of the... So the PBC, I should have mentioned that before, much longer than the Fed actually looked at monetary quantities, and is still set to do so today to some extent. And we are interested in loans because currently housing plays a big role, and one of our variables, of course, is the loan rate. So we want to include loans specifically. So we have our financial market, which is loans, M2, and the states extracted from our yield curve estimation. So we have macro. Macro is industrial production, prices, and housing sales, because again, housing currently in China plays a big role. Then we have our monetary policy sector, and then we have our financial market sector. And if you believe that this sequence of the three blocks is correct, then the only thing that really matters for the identification of those shocks is this order between those two. So is B rate first or repo first? And lucky for us, it does not matter, because nicely enough, which rarely happens in econometrics, they come and are orthogonal. Pretty much there is no, the benchmark rate has no on-impact effect on the repo rate and vice versa, which means for identification it's pretty much the same, however, which sequence however we choose. So as long as you believe that policy can react to the macroeconomy, but not to the financial sector immediately, we are good. Then this identification works, although it can technically be done with a simple Koleski decomposition. Again, we have very little data. I mentioned that before. I'm not a big believer in what's now super popular, like Bayesian econometrics. So I do the same thing with a different name. In this case, we use a lasso VAR. So lasso is least absolute selection and shrinkage operator. So it's basically, you change the objective function of the VAR to not only include squared residuals, but to also include absolute coefficients. So large absolute coefficients are penalized when what de facto happens that it pushes some coefficients to zero, which are usually insignificant and not important. And then we re-estimate just restricting those coefficients to zero, and using actually seemingly unrelated regression approach to account for correlation because, well, anyways, that's all very technical nonsense. Long story short, we use a lasso VAR, so that removes some coefficients from the VAR. Because we have quite a few variables, because remember, macro is not one variable, that's 3, 4, 5, 6, 7, 13. So that's a 13 variable VAR with about 100 observations. So as soon as you want to have a couple legs, that's a lot. So we really run into issues with degrees of freedom, so we want to reduce the number of parameters. We do that by using lasso and pretty much dropping all the coefficients we don't need. Then we still have a problem that's not mentioned here. We still have small sample issues because we only have like 1.5 business cycles. And you can actually show that small sample bias is not so much an issue of how many observations you have. Usually people tell you you're fine with 30, 40, 50 observations, but that's usually based on the idea of quarterly data. We're like 60 observations, which is usually very, very good, is 15 years, which is 2 business cycles, and you're actually golden. But if you have monthly data, the same number of observations corresponds to fewer cycles. And so long story short, you still have a small sample bias, although you have maybe a lot of information. Actually, you can, if you use daily data, you can have thousands of observations and still have small sample bias in time series models. And that's why we also, on top of all that, have bootstrap-based bias correction. So it's small sample bias corrected lasso VAR Cristiano-Eichenbaum-Evans identification. That's the combination of techniques we use. And that gives us the following partly nice, partly horrible results. So it's always top panel is repo shock, bottom panel is loan shock. And then we go kind of topic by topic. So first one is on the other interest rates that you kind of see the basic, how do the two policy rates interact? Are they the same thing? And the answer is no, because you see on impact they are uncorrelated. This is a restriction, because in the model that we present here, the repo is not allowed to affect the loan rate, which comes first. But here, if you look at the other one, you see that's also pretty much zero. And while this is a restriction, this is not. So this is an estimated pretty much zero. Also, what you kind of can expect, so de facto the loan rates follow more of a like stepwise function. Of course, you don't see that anymore because it's a VAR. That's a common problem in VARs. But you see that the loan rate actually after the shock has some persistence, while a shock to the repo rate actually dies out very, very quickly. And that's also kind of in the nature of things. So this is kind of plausible and what we would expect. Loan rates more persistent, no immediate correlation, but they kind of do have an impact in the correct direction on each other. So eventually loan rates follow repo rates and the other way around. So then the other thing that's actually interesting for us, do we still have time?
Yes, yes.
Okay. So how do the financial markets, how do interest rates actually respond? So I told you what we have in the model are actually the states from our yield curve estimation, but I find states kind of hard to interpret. So what we do for the graphical representation in impulse response functions is we translate them to short and long-term interest rates. So what you actually see here is the impulse response function of 1 year and 10-year interest rates on the interbank market and the exchange market. So it's still upper panel repo, lower panel loan rate shock. Left is interbank, right is exchange. I'm not sure why I'm always pointing at this one also. This is the big one where I should be pointing at. You could have said that, but I'm doing a completely stupid thing. Okay, anyways. Well, actually, it's still much nicer pointing here because it's so close. So first, repo shock. Remember, the repo shock is kind of the market shock, where the PBOC actually does something. And what we observe here exactly matches kind of the story I told you in the beginning. So open market operations happen on the interbank market. And then kind of the repo rate as a big bank rate is kind of determined by the big banks. So when there is monetary policy, you see it on the interbank market immediately. You basically not see it on the exchange market, neither on the short nor in the long maturities. Short run, like if you look at the very left of both of those pictures, there's pretty much nothing going on, although there is a massive shock on the interbank market. But it catches up. So there is this convergence we talked about before. The markets do converge to each other, but it takes time. So there is no arbitrage, but eventually they converge to a joint equilibrium. So here you have this big shock that slowly dies out, and it's pretty much a parallel shift of the yield curve. So you see that those two are actually very similar pictures, right? You see that those two are very similar pictures. They're not the same, but actually from a statistical perspective, they kind of are. So basically, you don't tilt the yield curve in response to repo shock. You move the yield curve in parallel in response to repo shock. And then kind of the effect dies out over time. If you look at the exchange market, there is no immediate impact, but it catches up to the yield curve, yield curve on the interbank market, and then they kind of keep dying out together. What you can't probably see well, what I should have stressed more, if you actually could read the numbers, you would see that the largest number on the interbank market pictures is 0.09. This is 0.04. So actually, this makes a lot of sense because here So kind of this peaks around period 15, and if you look here around period 15, it's also roughly a 0.04. So pretty much it catches up, and it catches up to the level that the interbank rate has at that time. So at the interbank market, it has already partly died out. So it catches up to the point where the interbank market is at that point, and then they kind of go back to normal together. And again, that kind of matches our story. There is no arbitrage, but there is, possibly even through the real sector, some convergence of those two markets, but this is where policy happens, so that is where you see policy, this is where you do not. Then, loan rates. Very different. Loan rates move both markets. And that again makes sense, because everybody responds to this regulation, because nobody wants to mess with the PBOC. So both actors on the interbank market and actors on the exchange market respond at the same time to this type of policy, because it is not policy conducted on one market that then has to be transmitted. It's kind of regulation, and then it originates on those two markets, or from participants on those two markets. So actually, you see an immediate impact on the one-year rate on both the interbank and the exchange market. And interestingly enough, the impact on the long horizon, I'm standing in the way, maybe I should keep standing here. The impact on the long horizon is much smaller in both cases. So actually here, the big difference is actually twofold. So first, it happens on both markets now, at the same time. And in both cases, it actually tilts the yield curve. So loan rates actually only seem to affect the short end of the yield curve much stronger on impact, and do not seem to have a major effect on the long end, at least on impact. But again, key point, very similar on both markets, and again, makes sense given the story I told before, because it's regulation. It affects everybody. Now let's come to the pictures that I really don't like to talk about, because they are not what I like to see. Let's start with the one that's less horrible. Let's start with the loan rate shock. Loan rate shock actually kind of does everything that a monetary policy shock should do. So remember, it's moving policy up, so it's a contractionary shock. So here GDP goes down, CPI is kind of insignificant, but if anything it goes down, money goes down. That's all nice. For repo shock, we kind of on the short end have both a CPI and a GDP puzzle, which is kind of very annoying. And we can't, yeah, that is, I mean, it's not large actually. Like, so the numbers here are tiny, but it's still significant. So we do have a price puzzle and we have actually a production puzzle. But the long run impact on GDP is what we expect to see. We have fairly reasonable results for M2, which also makes sense. So here what you see basically, there is a large impact immediately. It then goes back and then something happens. And if you think about it, it makes a lot of sense. Why? So what happens if you have open market operations? You do your trading, and since the monetary base is part of money, money immediately changes. So that should happen. Money should respond very quickly to monetary policy. That's in the nature of things. So money does respond to monetary policy just like it should. But then actually, banks don't like having things like messing around with their assets. They just have more money now because, well, the central bank gave it to them. So basically they rebalance their portfolios, and that kind of brings them back to normal, and then they start responding to like the actual incentives of the changed interest rates and reducing money again. But so basically the on-impact thing is kind of first negated because they want to go back to normal. Because actually banks don't like it to have to shift around things immediately because, well, I mean, there are reasons why you give loans and stuff. So actually, this is mostly reasonable. This is the one that really sucks. So if somebody gives me a good story for this one, I owe you a beer. That's just a horrible result on repo on CPI. And then finally, loans and housing sales, which we call real estate here, but it's total housing sales. So if you look at the repo shock, it actually affects both, but not very quickly. So the effect is significant, and again in the right direction. So loans go down and real estate sales go down, which is actually a good thing because they want to, like, one of the main reasons for contractionary policy in China those days is that they want to avoid a housing market bubble. But it takes quite a while until there is an effect. If you look at the loan rate, the effect on loans happens much faster, but it's actually not very long-lived. And if you look at this one, it's kind of, on impact has even an adverse effect. It turns it to the right direction very quickly, but here that's kind of the key problem. So if you affect the loan rate, what seems to happen is that they follow kind of the letter of what you're saying, but it's not very persistent, which again makes sense. Because if you really affect the market, you actually change incentives, so people change their behavior, so they get less loans. So here, we have this immediate impact because we have regulation. But actually nobody wants to do that. That's kind of, it's not backed up, there's not actually more liquidity. So actually kind of banks and consumers and everybody tries to circumnavigate this regulation, and after a while it seems to work. So actually loans catch up very quickly after this loan rate regulation as opposed to market-based policies. Which is interesting because the repo rate itself actually dies out much more quickly than the loan rate. But basically what happens here, at least that's our interpretation, is that basically the loan rate just becomes less relevant because, well, people find other ways. And in China, for example, and they're now really cracking down on that, and that might or might not be in the follow-up paper. So now it's a big thing actually to avoid shadow banking, because that's basically where the people went. So actually we know that there is a huge amount of shadow banking in China, which is then basically out of the loan rate regulation because it's not by the major banks. And I mean, people go crazy. Like, I mean, you can't say that in China, but they're really like, some people really, really still want to buy real estate. And so the government is more and more trying, and so that's not really part of the paper anymore, that's just anecdotes, to like kind of reduce that to avoid what's happening in the US. And to a certain degree it's working, because the main problem in the US that many people basically had houses that they could never possibly afford from their actual income. And in China they really want to avoid that, so I think the required down payment for a house is now 20%. And if you want to have a second one, it's higher. And it fairly quickly goes up to 100%. So basically you cannot just buy 10 houses on credit. It's just not allowed. You, like, first one you need 20% down payment, then I think it's 30, 60, 100. So it goes up, it ramps up fairly quickly. But so people want houses and they're liquidity constrained. So for example, that is per household. And I literally know a person who forged divorce papers that she can claim that she and her husband are different households, because then they can buy 2 apartments at the 20% down payment rate. Right? Because then it's no longer one household and the regulation is per household. Like, people are still really excited about real estate. And that's why the PBOC is kind of trying to really put a lid on that. And now, again, far beyond the scope of that paper. So if you have questions on the paper, interrupt me and I will talk about the paper again. But so now they're really like cracking down on that, and especially on shadow banking, which was kind of the main channels. Like, very few people actually like claim their divorce to get that. So most things were just shadow banking, that they got like credits through like channels that were not that obvious that it's housing and stuff like that. And so shadow, like pretty much most of the monetary policy in 2017 and a lot in early 2018 was about reducing shadow banking to an extent that actually now credit by non-financial corporations is forbidden in China. So they really, really want to avoid that. That's kind of the big issue for the future. Because apparently, like, the loan rate policy alone did not work very well. And again, here you see why. Because the effect on loans died out super quickly. Like, loans go down if you change loan rates, and then they immediately go up again. I mean, that is not an effective policy. And not necessarily because it's a bad policy, but just because people found ways to, as I said, circumnavigate that. So basically, my interpretation of the current policy is they pretty much want to avoid that people have the option for this, like, bouncing back. They just want to avoid what's happening here. Anyways, that was my paper, our paper. Thank you very much, and I'm excited about your comments that will hopefully come.
Thank you very much, Makram, for this very interesting presentation. Actually, in Cape Town, you made the presentation in 15-20 minutes, so today it was much clearer for me, so it's a very, very interesting paper. Let's go for the questions. I do have some, but let's collect from the students before. If you want to sit. If any of you is shy about talking in English, you shouldn't be, but you can raise the question in Portuguese and I can try to translate it. Well, if not, I can start while you think about it. First question. In Brazil, we have, and in many other countries, but I don't know in China, and that's the point I want to ask you. It's really hard for us to even analytically split what is monetary and what is exchange rate policy, because everything is together at the end. We have a flexible regime, as you know, and then the monetary policy is normally related, not always, but normally related also to this exchange rate policy. So we increase the interest rate when we have problems with the exchange rate in order to attract capital and so on. And then, so this is my first question. What about China? Do they have, I assume that it's not that mixed, but then I went to listen.
Well, actually, I'm not sure. So maybe I answer question by question, and I don't have to remember more than one question. So yeah, I mean, I guess it's kind of managed floating in China now, as you probably know. So the RMB exchange rate is not fixed anymore, and actually it wasn't fixed for pretty much all of our sample, but they still intervene heavily. They claim to neutralize it, well, they claim to compensate it on the national market, but I'm never sure how much this really works. So I guess what we measure at monetary policy shock kind of probably is both kind of. We actually didn't try with the exchange rate in there. We could probably try, but actually the variance of the exchange rate is not very, very large. That's one of the problems why exchange rate in Chinese VARs usually doesn't work that well. We could possibly try that to maybe filter out a little bit more. So my best guess, but again I can't prove that, but my best guess is that we probably would get slightly smaller monetary policy shocks because we could probably explain a little bit more. So actually I guess the residuals would go down, so the shocks would be smaller. But I doubt that we would find a major difference, because for most of our sample there was no like major exchange rate issue in China. I mean, they were like stabilizing the path a little bit, but that was pretty much it. It might be, again, it depends very much on the sample. So now with the trade war going on, or like a really steep depreciation, which they seem to like slow down, things might be very different. But for our sample, I would say it was little enough that the impact on identification should be small enough that our results should hold. So I would say it probably would be smaller shocks, but the dynamics of the VAR shouldn't change. And I think the shocks would still have the same direction, so at the end of the day we would still find similar pictures, but bounce back. But that's a guess, I didn't actually try.
And just to give you some figures about Brazil, because now we are working with this BRICS network, even for the repos in Brazil, actually we do have reverse repos mainly in order to decrease the liquidity of the market. And one of the main reasons is precisely the effort made by the central bank to attract. You are worried about the yellow figures.
Yeah. I forgot my vaccination. I'm very upset. Because even in the plane they told us, if you did not get your yellow fever vaccination, make sure you dress long. If you get sick, immediately go to a doctor. That kind of made me panic. I spent half my money on the mosquito repellent, but I think it's wearing off.
Well, during this commodity prices boom, we had these massive inflows of US dollars in Brazil, like in many other peripheral countries, and the central bank had this effort to increase the international reserves. One of the ideas was precisely having this mattress, let's say, in order to protect the country about capital flights or to preserve the exchange rate stability or decrease the instability at least. And then having this increase, US dollars massive increase or inflows, the monetary policy was made in a way that the idea was reducing the liquidity through reverse repos. So we had a huge increase in the reverse repos in order to sterilize the US dollars inflows. So it's not the only reason, but when we see the really high reverse repos we have in Brazil, like half of it is due to the US dollars inflow. So everything just should tell you that everything is together in Brazil. Everything is mixed. Monetary policy, exchange rate policy.
Listen, at least they claim to sterilize.
Yeah,
I'm not sure how well it works, but they claim that they can keep it separate. Also have some doubts, but
nobody. Another question, I don't know if you know it, but you know that one of my main topics of research is the internationalization of the renminbi. The paper I presented in Cape Town was written with Paulo Fanoji, who is also a professor here. And then we are working on that. And when we think about the internationalization of a currency, it's important for the country that issues this currency to also have international bonds. Finally, what makes the US dollar important is the US dollar itself, but also the treasury bonds. Well, the safe haven for the international investors is not US dollar cash, but it's the treasury bonds. So I can imagine that for China, in this process of internationalizing the renminbi, they are also aware that they have to internationalize their treasury bonds. So it was nice for me to see. You showed that finally they have it mainly domestically, the treasury bonds. But my question is if they are increasing the internationalization of the treasury bonds, or if they keep it only domestically up to now.
I think the market is still almost exclusively domestic.
Okay.
But they are promoting actually a bunch of central bank policies in the first 2 quarters of 2018 were specifically targeted of promoting the use of the RMB for international transactions. So not so much about, again, for investors as safe haven, more things that actually I think they had some clearinghouse regulation that made it easier to have cross-currency transactions and payments in RMB settled, and that made it easier for WeChat basically to be used internationally, things like that. So they are heavily promoting the internationalization. So far as I know, not very much the opening of the bond market.
Okay.
I think that's pretty much a Chinese market.
Okay. Please.
I have one question about you said that the government started issuing bonds not to finance but to try to influence the yield curve. And so it's a monetary.
The central bank tries to influence the yield curve. Well, I mean the PBOC is not independent, like at all, and nobody claims that they are. They're not supposed to be independent. Nobody says they should be independent. Well, at least not in China. But the government issued bonds to have a complete yield curve, so that the PBOC can control the yield curve. Because before there was really nothing to control, like about a yield curve, because if you take data from 2006, there literally is no yield curve. It's like 5 dots spread somehow.
Okay. So you can say they are separate. The government won't issue bonds to try to manipulate the yield curve. They would create.
No, it's different institutions within the government. The Treasury issues bonds, and one of the main objectives of the government in issuing their bonds and which bonds they issued was kind of to actually have a complete yield curve. So not to change the yield curve, but to have a complete yield curve. So they did not, as far as I know, they did not really strongly use the issuing of bonds to actually influence the yield. That's why I think it should be separated. So because the Treasury issues bonds, and they basically just take the yield curve as it is, but then the PBOC does policy to change this yield curve.
Oh, okay. And can the Bank of China buy these government bonds in the primary or in the secondary market?
They do buy, they definitely buy. I'm actually not sure if they buy on the primary or secondary. I don't know. I don't know. Well, yeah, I don't know.
But they are allowed to buy.
I'm pretty sure that they're allowed to buy. I'm pretty sure that they hold. I'm 90% sure that they hold Chinese treasury bonds. I have no idea if they buy them directly or not.
Okay, because in some countries it's not allowed.
I know, yeah. But that's actually a very good question. I definitely have to check that, but that's actually a very good question. I don't know.
Yeah, I have it's related to Nicolas' question, because usually countries, they try to control or influence the yield curve to affect the loan rates, right? That's what they did in the US, in the QE, and so it goes. But I don't know if I got it right, but in China, they kind of control directly the loan rate.
Yes.
So my question is, why do they want to influence the yield curve?
Well, I mean, a lot about yield curve control is, of course, about long-term expectations, right? By controlling the yield curve, you make kind of a statement about the future.
Yes.
And I mean, that's why it's now a big thing in the US,
yes,
that you kind of want to do something to credibly confirm that you will do a certain kind of policy in the future. And I guess it's the same thing. It's basically having at least to some degree, predictable and policy where you constrain yourself credibly to a long-term policy path is kind of important, and that's, I guess, what the yield curve is about. It's a bit harder to say why they actually do the repo and the loan rates, which is not the same, really, but here I would really say it's about the way of financing, that it's specific types of activity that are usually financed through loans, and others that are financed through bonds. For example, real estate is very often financed through loans. So if you, for example, do loan policy, you can you could basically, for example, be expansionary and basically increase liquidity in the market. So it would be easier to issue bonds for companies to actually refinance investment, while it's at the same time more difficult for consumers to buy a house if you increase the benchmark loan rate. So basically, through the difference in use between different types of refinancing or financing, you can actually do some micromanagement in what people do with their money. And again, in China, housing is now, it's really a big deal. Because nobody really says it, but most people are worried that at least in some cities there are housing bubbles. It's not even necessarily those cities with the highest prices or highest price increase, which like Shanghai and Beijing, because so many international people are coming and actually driving the prices kind of to international metropolitan standards. And to be honest, there's no reason why Shanghai should be much cheaper than, say, New York, because they have a very similar clientele. The problem is those second-tier cities, which then mimic this development without necessarily having this kind of demand backing it up. A lot of people just, like, it's just what you're supposed to do. You're like supposed to buy a house, so everybody wants to have a house. And, they don't even live there. Some just like buy a house, like they have a house. Like, so for the future, maybe. And again, that's some concern. I'm pretty sure it's not as bad as in the US, as I said before, because they're a bit more restrictive. Like most people. So I think the Chinese regulation has worked in so far that most people only have the house bought on loan or mortgage that they actually live in and that they can afford from their income. They might still lose a lot of money if it loses value, or they might have overpaid, but unlike the US, they would not be kicked out of their house because they can basically keep paying the mortgage from their regular income. But again, that was like not really the answer to your question anymore, sorry. I kind of just gave a little talk.
No, it was nice, thank you.
More questions? So let's come to your beer challenge.
Very good.
The puzzle is that increasing the repo rate, a shock in the repo rate increases inflation, that's it?
Yeah.
Okay. And isn't it that, because the repo is getting bonds for a while and giving cash, right?
Yeah.
Wouldn't it possibly have a positive impact in inflation? And it may be also...
No. If the interest rate goes up, it's actually getting cash and giving bonds. Interest rate up is they remove cash from the system. That's the point. It's a contractionary shock. There's less liquidity in the system. We do see, and that's the weird thing. We do see it in M2. We do see it in loans. Like everything is going in the right direction.
But inflation.
Except inflation. Which actually, currently the best explanation that I came up with is that it's actually kind of just statistical noise. Because it's actually, while it's statistically significant, it's not really economically significant. It's all very small. You don't see that it's small because it's all like scaled so that the picture looks nice, but it's actually a small effect. And actually, I guess maybe consumer prices are not where basically excess liquidity currently goes. It's really mostly about the housing market, and there you see the right effect. Okay. And you see a meaningful magnitude. So I guess, that's my best guess. That this is basically noise, and what's actually happening is that most monetary policy currently, because the one big thing where kind of people change their marginal decision is not if they go to the restaurant once more or one last time. It's, do I buy the house? Do I not buy the house? When do I buy the house? Because a house now it's a huge thing in China. So also culturally. So here, I should talk about institutions. So that's kind of a non-political institution. So if you want to get married in China, you're supposed to have a house. And I know people, sorry, I'm paranoid about mosquitoes today. Anyway, so I literally know a lot of women who completely openly say, like, even if they love their husband and everything, no, I refuse to marry him until he bought the apartment. Because that's how it's done. Like, either the husband buys the apartment, or what very often happens is actually that the parents are supposed to buy the apartments for the young couple, with the idea that then, actually the parents of the husband are supposed to buy the apartment, and they buy an apartment which is sufficiently large so that they can move in once the couple has children, and then kind of they move in and look after the children while both parents work. And then when the children are kind of not out of the house but school age and don't need that much supervision, they are old and fragile and still keep living there, and then eventually the mom quits working and looks after her in-laws. That's kind of the generational deal that's currently going on in China. And again, the house plays a key role there. Like, you need to have a house. So like a friend of mine, he's Canadian and wants to marry a Chinese girl, and she says she can't get it past her family to marry him without a house. Like, he needs to buy a house first. It doesn't need to be a great house where they can actually live, but he needs to have a house. Man without house is not marriage material. It's just it's a deal breaker. Just to give you some impression of the cultural relevance of a house in modern Chinese culture. And maybe the other thing is that many people just got rich from those houses. Basically, a colleague of mine, when he was a young man, basically for that reason, he bought a house in Beijing when it was still cheap. So she's 10 years older than me, and I guess he bought his house when he was 20. So 30 years ago, before the big boom started. He basically became a dollar millionaire by just having this house. And I don't think he even ever actually lived there. But this house was pretty much the foundation now of his wealth. So there's also this whole generation of people now who have this success story with their house, which of course also plays a big role. And for a long time there was increasing demand, because if you most of you, from what I heard, have been in China, right? So what you very often see is you have those old neighborhoods, which are 1, 2, 3, 4 story tops, right? And so houses, they are tiny. People had 40 square meter, maybe 60 square meter houses, or apartments for a whole family of 10. And now they all move to much bigger apartments. In the community where I live, I think most apartments are 100 square meters and more. And usually it's 3, 4 people living there. So it's fewer people living in bigger apartments. So actually for quite a while, because people became richer, and so one of the obvious things that you want to do, because one of the kind of main constraints before was space, you lived super cramped. So first people got decent food and decent medication, and then the next thing is you want to live in a nice home. And so for a long time, housing demand was actually exploding. So, but now they still keep building and prices keep increasing, although population will now be shrinking and many people now have their big house. It's kind of just too much extrapolation of the previous development going on.
But there is still a lot of people to move to the cities, right? Compared.
Yeah, but I'm not sure, because again, that's the really few big major cities. So it's not I live in a place which has if you include the metropolitan area, I have to use that in quotes because for Chinese standards it's not metropolitan at all. So it's about 5 million people. I'm told it's a third-tier city. It's considered I literally, Chinese friends ask me, how can you bear living in such a small place? And that is not a joke. I literally had 2 people independent of each other asking me that question. How can you live in such a small place? Man, it's the kind of city proper, the city, densely populated is 1 million. With the suburbs, it's 5 million people. For any practical perspective from a German person, that's a huge city. But for Chinese people, that's a tiny place. And that's not the type of place that's really, well, it is growing, but actually I don't think population is growing much. I think population is actually going down. It's still growing in size because, well, people are living in more space. But the places that are actually growing super fast are Beijing and Shanghai, where the people go to work.
Okay.
But still, they're building like crazy. And so currently, so it's a little bit like in New York, the naming system of streets, which makes it very easy. So they have those north-south streets that they call first, second, blah, blah, blah. And like in the new part of town. In the old part of town, it has actual names, like in Europe. But then in the new part of town is the west part. And so it just moves west. And currently, I think what's kind of settled is 5th Street. And even there, like now the communities start to fill. And behind that, there's pretty much nothing. They're selling apartments on 15th Street. So 10 streets further. In the middle of nowhere. And there's literally nothing. Well, there's 6, 7, 8, but there is nobody. But they're selling apartments there, and people are buying those apartments. Which might be a great place in 10 years. Or might not. Well, it's basically and it might work. Like everybody thinks, oh, the city is moving to the west. Like a lot in the east will just like basically kind of be abandoned and the whole city is moving, and they speculate on that. And they might be correct. They might not. And then they have a house in the middle of nowhere. Because of course now other people realize, you know what? Now that the land is so cheap, close to those like 1,000-year-old scenic spots, wouldn't it make much more sense to build a new apartment complex here that you tear down a few old buildings, build a great apartment complex here, rather than on 15th Street? And so you have both. You have one investor doing it next to the nice scenic spot in the east, you have one investor doing it on 15th Street, and at the end of the day, only one of those can win their investment, only because there are just not enough people to fill both. Because of course they're not 2 stories anymore, they're now like 30 stories. They're like giant buildings.
Any other question? Okay. Okay, Camilo.
I would like to ask you for some of the distributional effects of the monetary policy, because if it's like in the rest of the world that when our countries adopted the inflation target, the share of the wages on GDP began to falling, and probably if this innovative arrangement in China.
So China has growing inequality. We don't have enough data, like at least for this kind of monetary policy analysis to test that, so I didn't, so I really can't say. I'm not sure if we generally have enough good data, because like for those type of effects you need sufficiently long time series. And then also like inequality data is like hard to get by and usually not monthly. I would not be very confident in an empirical analysis in China on that, but there is growing inequality. But first, actually, I think I once read that in the US it's growing faster, which was actually surprising me. And the other thing, and I think that's why in China nobody really bothers, although people always think, oh, they should, because everybody seems to benefit at the end of the day. So this like trickle down, China seems to be one of the few countries where this is working. Like if you go to the US, over the past 30 years, rich people got richer, but basically like a worker like in a car manufacturing or whatnot, like a simple like blue collar worker in the US today in the 80s, he's not much better off. Like I mean, maybe a little bit if you say that they did a wrong hedonistic price adjustment, so he has a better phone and stuff, but altogether they're not much better off, say, and the rich people are much better off. But in China, over the last 30 years, everybody was better off. Like literally everybody. Like one of my colleagues, like both of her parents are doctors, like medical doctors. So depending on who you are, the right or the wrong kind of doctor. But so they're not poor people. They're well educated and have a reasonably good income for China. But she tells me that as a kid, they didn't have hot water. So actually, in winter, they used a public shower, like once every 2 weeks. That's how often she showered as a kid in winter. Because you had to go to the public shower and take a shower there. Because, well, like, in your house, you would have frozen to death if you took a shower in winter. So you just didn't. And again, that was like a kind of well-off family. They were not poor people. And today, if you're a doctor in China, you have a very good life, you have a nice house, you usually have a car. And just like the number of cars that increased, like, oh, I'm living there for 4 years. Number of cars has doubled. And so I drive a small Chinese car. And so when I started, it was just one of many small Chinese cars. And now when I look around, I feel like I look like the poor person. Like, I literally, like, my social life, like, it's only acceptable for me because I'm the cool European. I can kind of do that and say, no, Europeans like small cars. Like, none of my colleagues drives a car like me. None. And I'm not joking, none. Literally none. They all drive nice European cars. I'm literally the only one now with a cheap, shabby Chinese small car. And if I wasn't white, that otherwise they would say you're a crazy person. But this way they can't say that, oh, it's only because you're a poor or a stupid person, and they claim, oh yeah, he's a weird European, they do that. But that's the only reason that I get away with that. Like, the number of cars have been exploding. Like, I suddenly see like Maseratis, Porsches, BMWs, Audis, and not the small ones. Like, it's like exploding. Or even like the poor people now, at least you have your like those electronic scooters. Like, everybody is visibly better off. Like in California, and again, that's not like, it's not a place like, I don't know. If you don't see beggars on Tiananmen Square in Beijing, you can say, okay, that's because they don't want to ruin the pictures and they don't have beggars there. But literally on a day in like my hometown in Germany, which has like 100,000 people on a single day, I probably see more beggars than I have seen in my 4 years in my city in China. I mean, don't get me wrong, people are not all rich. But there is also, at least if you're not in the countryside, where apparently there still is poverty, especially if you go really far west. But even in those like what they call a third-tier city, there is no like real visible extreme poverty anymore. Like, people get by. They have their small shops. They might be small. They might only have this scooter and like sell you vegetables or whatnot, but they get by. They have decent clothing. They have decent access to medical services. They have like a vehicle of some kind. And again, their parents didn't. And I think that's the trick how China gets away with this inequality, because really the poorest. Like, I mean, Jack Ma got rich faster than everybody else, but even the poorest in China had better growth experience than pretty much anybody else in the world. And that's what makes them happy and calm. And I mean, like, really, I think that's what the Chinese government just realized earlier than anybody else. That you cannot control people in the long run by just like oppression. The only way to make people shut up is to make them content. So they make them content. You want to be rich? Be rich. And that works. Again, that has nothing to do with that, but since I'm talking, you can stop me anytime. So, I mean, Germany has this like big experience with the reunification. So we had like the communist half, which was like an oppression control, and then we had the reunification of the West. And everybody was super excited, because we thought, oh, they want their freedom, and they want their freedom to travel, and blah, blah, blah. And then everybody was super pissed when they suddenly immediately started voting for the communists again and hated all the Westerners. And the reason was very obvious. Like, it seemed that they wanted to have the right to travel. They didn't want to have the right to travel. They wanted to have the money to travel. And we only gave them the right to travel, which kind of made it even worse. No, they had a neighbor who could travel, and they still couldn't travel. Like, that was like in China, say, yeah, sure, travel. Like, if the US gives you a visa, go. Do whatever you like. And everybody's happy. They let people travel, and they let people have money enough to travel. Of course, the US still doesn't let anybody in. Like, if you're like between 25 and 40 and female, your chances for a US visa are very small. Basically, if you are fertile, female, no chance. And that's actually no joke. They had a real industry there, like people who wanted to have their kids born in the US. So now the US pretty much, if you could have a kid, no. which is really not monetary policy.
More questions about monetary policy or daily life in China? Okay, so Makram, thank you very much for your very interesting paper and presentation and for all the discussions we had later on. And I hope it's only the first step of our collaboration.
No, I hope so too. Thanks for having me.
Thanks so much.